America economist at PIMCO. She joins me from Newport Beach, California. Great to have you on. That was a really interesting graph. I mean, finally seeing that inflation and what we're seeing on the interest rate front converging. You're not sitting in negative real interest rates anymore. And I guess the question is are the higher interest rates impacting inflation as quickly as the Fed had hoped?
Well, I think funny enough, so you guys have mentioned you've seen the year-over-year rate of inflation come down. So from 9% to I think 5.5% on a year-over-year basis today. You know, and I would actually argue that that had very little to do with the 5% increase in the Fed funds rate over the last, call it year and a half. And that's because monetary policy works through long and variable lags, and we did have, pandemic-related supply constraints as well as just, the pandemic-related response, the fiscal policy response, which was a one-off event. Those were kind of one-off factors that were reducing inflation. Those have more recently gone away. And I would argue that's the reason why inflation has come down more recently, and we haven't seen the full effects yet of monetary policy because of those long lags. So as we continue to see inflation, or we expect to continue to see inflation coming down, that's really going to be more about monetary policy. And so I think that's why you hear Jay Powell talk about the uncertainty. We could need to do more if inflation doesn't come down as much, or we may need to be cutting, as the market suggests, because we did too much already. And that's something that's a debate that's going to play out.
But as early as July, cutting as early as July, as Matt was saying, that, there's a 44% chance, at least that's the probability that's out there. That sounds and feels a bit too soon.
Yeah, I mean, we would agree with that as well. So we do think you are probably going to see a recession in the United States later this year. I'll bet a mild one starting later this year. And again, that's just because of the amount of monetary policy tightening that we've seen to date. And of course, that has had, an impact on the banking sector. We've seen a rising cost of capital for banks, and stock price decline, I think 30% on average across the banking sector. That's going to make it more difficult for them to make loans, and that's going to ultimately cool off the economy and bring down inflation in our view. But nevertheless, inflation's still elevated today. It's probably going to still be elevated in July. So we would completely agree that probably the Fed is not going to be cutting rates when inflation is still this much above their target.
Yeah. The whole issue about whether the 2% target range is actually realistic is a time for, casting a wider net and looking at an overall range, say between 2 and 4%. Do you think that will be on the cards at some point?
Well, I mean, I think there is a lot of potential credibility issues if the Fed were to move the goalposts on its inflation target while inflation was still elevated, right? They're basically then saying, well, we can't hit our 2% target, so we're just going to raise the 2% target. So there's potential credibility issues there. But nevertheless, I think they could keep that formal 2% target, but do kind of what they did in the 90s. They can be okay with a little bit of an upside miss, kind of 3% maybe, be okay with an upside miss for a little while, knowing eventually it could get back to 2. One thing that people forget about Volcker, by the way, and Powell is wanting to always channel his inner Volcker, is that Volcker didn't bring inflation down to 2. He actually brought it down to 4%, and it wasn't until 20 years later, 2 recessions later, that it went to 2.
Okay, so I very quickly, I want to talk, and you mentioned potential of recession later this year. What about other externalities? Geopolitical issues, I think top of mind globally. If you see any other shock on commodity supplies, and that could, of course, impact inflation down the line. It doesn't seem that there's a buffer here to be able to protect the United States. Inflation is at risk.
Yeah, I think that's absolutely right. I mean, usually you think about supply side shocks like you're talking about as stagflationary, where you have inflation that is rising again and real growth that's, decelerating or even declining. I think that's the real scenario here that's really problematic for the Fed, because they probably can't cut because inflation would still be elevated. And that's usually a recessionary period is usually a time when they do need to be cutting.
Tiffany Wilding, great to have you on. Thank you so much for your insights. Well, inflation is